Live, folks. Welcome to another Thursday Night Stock Charts Live. We're going to call this the very special earnings edition, and we're going to go over trade management of Netflix, of which unfortunately I'm involved with, and I'm going to talk to you about selling strangles, meaning option trading, option writing, the downsides, and the not so much the upside. I'm not gonna put lipstick on a pig here. It's not my job to go to CNBC for that. But we're going to talk about strategies for how to manage these trades so that you could effectively manage your way out of a trade, assuming that you weren't too grossly overweight the trade and you leave yourself with a lot of liquidity so you can maneuver and make moves to help reduce your basis cost, because this is a trade that went against us. There are plenty of channels on YouTube where you can go to and get pie in the sky, make $500 a day every day when you're sleeping, make $500 a day. And I'm not going to do that here. We're real, and that's not what we do. No hopium, just reality. We're going to talk about the economic data. What happened in the markets today was significant. And we're going to take a look at the weekly charts to identify if we have a market that is in serious trouble. We're going to go over some headlines that are out there that cause me some concern, some headlines that drove the market's price action today, despite the fact that we moved up higher at the open, very, very strong. It did not end well. We're also going to talk about Disney. I've been talking with one of our members, Donnie. Donnie is in a trade on Disney. He's underwater on that trade. So we're going to talk about how to effectively find a support level on Disney. It does look like the support levels I had discussed with Donnie a few days ago are going to get challenged. So the question is, what happens when you get to those support levels, and where are those support levels? For that, we're going to be using TrendSpider. If you like the program, meaning TrendSpider's program, there's a 35% discount code below. I give it away free to our silver and gold level members. And please, from the outset, click the like button, subscribe to the channel. Thanks for being here. And I'll try not to hit the mic. Let's get to it. All right. So I want to begin with the overview, where we're at. I did this on Sunday night. I'm probably going to continue to do this for a while anyway, because things are beginning to change a bit. We are here. This is your market cycle. In blue is your stock market. In green is your economic cycle. We are clearly moving lower on both. So the sectors that have worked of late, basic materials, staples doing still phenomenally. Energy, big problem with energy this week. A very, very bearish setup. I pointed it out to members, I think it was 3 days ago on the daily chart, and we had a continuation move lower today. So it looks as though we are beginning to see continued weakness in the overall economy, with the market now following suit. Let me say hello to people. Talon, hey, brother. Larry, who trusts hedge fund manager Bill Ackman? Not me. Nobody at his keyboard does. That's right, at his keyboard. Let's ride the Josh Brown chain. He bought Netflix today. Apple, Amazon, or Google could buy Netflix. Was that his logic? That it's a buyout candidate? For the first time ever, it probably is a buyout candidate. I'm going to go over the reason why in a moment. Paul, so where are we exactly on the? That's a great question. We are here. I believe that we've already begun to see the beginning of a bear market in equities. Let's face it, we topped out on the small caps. Q1 of 2021. We'll go over the chart of the S&P 500. When did it peak out? The only caveat here is that we peaked out back here in January. We're not down 20%. That's the benchmark, the rule for being in a bear market. Well, technically, you're in a bear market before you hit 20% because that's when that's when the unwinding began to occur. So I don't really use that 20% threshold per se. I want to be positioned in advance of the 20%, ideally. So I want to pick the top early on. So I believe that we are here, meaning we're done with a full recovery. I'll go to a chart in a moment on both economic and EPS peaks, and we are well beyond the peak now. And now we're in the early stages of entering into recession. I believe that we are at the beginning of a bear market on equities. We just haven't broke yet. Good evening, Franklin. Buster Stacks here, brother. Fang lost its yen. Yep, that was on Zero Hedge today. Yep. Mo, Mohammed Al-Arian warns of upcoming crash. He also pointed to high fluctuating bond yields. Yes, major problem. Yes. Old school traders used to say a declining 200 SMA is a bear market. Okay, I'll go with that. Okay, let's get to the economic data that hit. So we are here. We are right where this dashed line is, and coincidentally, today we saw a break in energy. Does it last or is it a pause? We're not sure yet. We don't have data yet, but warning flag on the track for energy. Economic data. Good home building index. The problem with the markets this week was not the economic data. It was the Fed heads. All the Fed heads came out and they jawboned the market lower. And you saw it. Look, even leading indicators came in with a beat. Initial jobs claims came in a little bit hotter. Tomorrow we get the purchasing managers index for manufacturing and services. That's going to be a tell. So if they come in weak, I'm predicting that you're going to see yields come in and that the markets may pop. Now, if it comes in hot, that's the green light for the Federal Reserve to move forward with more aggressive rate hikes. Now, what killed the market today was the flurry of comments out of Fed Governor Bullard, Daly, and Fed Chair Powell, hinting at half-point rate hikes. The problem is this: is that we have priced in already 10 more rate hikes for 2022. But now they're beginning to price in rate cuts because they know what's going to happen here. This is going to be the first time in recorded history that we have a Federal Reserve beginning a tightening cycle into a recessionary environment. I didn't make it up. It was like that when I got here. The yield curve has already inverted and is threatening a steepening. So that's a clear sign that a recession is on the horizon if we're not already in one. Yet they felt it necessary. And given inflation, I understand why. I'm not defending them. They should have been ahead of this years ago, but they were not. And we're going to have to live with the consequences of their actions or inaction, I should say. Okay. So what I always like to say about the Federal Reserve is don't listen to what they say, watch what they do. And all day long, I was waiting for their balance sheet to get released. It ends on every Wednesday. It measures the balance sheet of the Federal Reserve. It gets released on Thursdays. And what we saw was after putting in a new all-time high last week, the balance sheet actually declined this week. Now, keep in mind that what keeps the stock market going is lockstep, tick for tick, moves up higher in the Fed's balance sheet. Absent a proactive Federal Reserve being in there and buying up equities, we have not equities, buying up debt. It's hard for the stock market to stay aloft because what we're looking at is this. We've already seen peak earnings growth and PE. I'm just trying to identify what this is trying to reflect. PE. Oh, yeah. All right. PEs have come in some. They're still overvalued, though. Don't let this fool you. PEs are still very, very overvalued. Yet we've seen peak EPS growth. So again, it's very difficult for this market to maintain this long-term uptrend when you have earnings per share growth declining and stocks still very expensive, and you have the Federal Reserve out there that is jawboning the markets down lower with their rhetoric. And then when you take a look at their balance sheet, it's beginning to top out. Okay. I wanted to go over this. Oh, I already did go over this. This is on another chart. Okay, good. All right, so what else has me concerned about the market besides the technical analysis we're going to do in a moment? Let's face it, folks. We have a very, very corrupt government. We have a war where, I believe we passed a $15 billion aid package, and every single day, it's another $500, $800 million worth of aid going over to the Ukraine, either through the replenishing of neighboring governments who are loaning their old equipment, not loaning, giving their old equipment to the Ukraine to fight a modern military. And what we're doing is we're sending brand new equipment to other countries. This is a gargantuan win for the defense industry, not so much for you and me. So the fact that we have not only just utter incompetence and corruption at the executive level and frankly at the congressional level and arguably at the judicial level as well. This from the White House. Black hole. White House doesn't know where U.S. weapons go after entering Ukraine. There is zero accountability. The White House has such little self-awareness of their damage that they're doing to our own economy. What they're doing is now they're resorting to attacking Republicans to justify why we have high inflation. I guess Putin inflation didn't work. Now they're going to try to blame the Republicans in advance of the midterms because Dems are going to get wiped out. Don't get me wrong. There's a uniparty in Washington. I don't believe that the Republicans are going to handle the economy any better than the Democratic Party right now. They're all the same party, unless, of course, we get a chief executive in there, Ron DeSantis, somebody like that, who's going to shake stuff up. And to further add more anxiety to the market, there are massive explosions that are taking place. Homeland Russia, outside 250 miles outside of Moscow, a chemical factory, one of the largest. Research facilities. I don't know where this is. Two major fires on air and space research centers. And it just goes on. I think we have a trend that there are attacks being carried out on Russian soil now. And God forbid, even if it's a NATO member, they have their fingerprints on this. The escalation is going to get ratcheted up. I'm not saying thermonuclear war or anything like that. What I'm saying is that from a stock market perspective, that will be the straw that camel's back and sends this market down lower. let's let's talk about the weekly charts, and then I'm going to leave off with the trade management of Netflix after earnings. If you're owner after earnings, leave a comment. Let me know if you're interested in this, so I know how much time to spend on the topic. Same thing goes for Disney. If you're interested in where Disney's support levels are and how you may want to consider handling the trade. And if you're going to leave a comment, let me know if you're long, short of either of these names with the symbol. And are you trading options? Are you trading equities, et cetera? Just give me more information so it helps me out to help try to customize my commentary for you. Okay, let's begin, folks. Yield curve. The last we spoke, the yield curve was much, we were steepening. While we're still steepening, this may be hard to see. While we're still steepening, we are coming well off the highs of the month. That is stock market bullish. When you are when you're steepening, when you're rising, that is not stock market bullish. That is bearish because that means your yields are rising. But today, what you saw were yields, which this is a weekly chart. Remember, we're going to go over. How's that? Better now? Testing, testing, testing. Is that better? Has there been no audio the entire time? Oh my God. Was there no audio the entire time? Or it just went out? God damn it. Freaking me out. I don't know what's going on with my audio lately. Okay. Oh, okay, good. Thanks, Will. All right, Will, I thank you for leaving this message. I am looking to get in on both Netflix and Disney. I was looking to start a position in Disney around 120. I would wait on that. I'll go over the support level on Disney. I'll give you the worst case scenario. That way you know where you want to put your stop loss. Thanks, Talon. Thanks, guys. Appreciate the feedback. Cool. Thank you. Okay. So I mentioned that I had expected to pull back on yields the other day because I saw a little bit of, I got the feel of some topping action. And we pulled back yesterday. Today, we got a continuation move up higher, but we faded a little bit. And when you take a look at the ultimate oscillator, which I don't use a lot, but I keep it up because sometimes it sends you signals. Take a look. We're breaking out to new higher highs, but we're putting in lower highs. We're weakening here. And your MACD, the histogram is clearly trending down, and your ADX lines. I always use the green lines to trend out. Are we losing or gaining momentum? And we're losing momentum here. So while by no stretch of the imagination am I calling for a macro top on the 10-year yield, I'm willing to make a bet that the guys at the Fed are going to be willing to allow the 10-year to go bursting through 3% because we're eerily close to 3%. I don't think the economy can handle it. So if the market gets the message by the Federal Reserve that they're not going to let the 10-year go through 3%, certain sectors are going to do well. Growth is going to remain under pressure. So keep an eye on this. This is just a hunch. I could be completely wrong here. Just a hunch, but we begin each thesis off with your hunch. It's intuitive. And then you look for technical data to validate your opinion. The reason why I'm spending so much time on this specific chart is because it's so important. It's important to every sector out there that we're dealing with, the direction of the 10-year yield. So moving on. Why else do I think yields are going to pull back? We did a trade earlier in the week on the TLT. Now, keep in mind, the TLT is the 20-year bond ETF. When bond yields go up, bond prices generally go down. Not this week. So as of the time of this recording, this week, the 20-year bond ETF is up on the week along with bond yields. That's a bit of a divergence. Granted, it's a 10-year versus a 20-year. Is obviously you have to reconcile those two a little bit. Okay, you have to acknowledge the fact you're comparing apples to oranges to a certain extent. It's not apples to apples. But the fact that you're seeing bond prices push up along with yields tells me that, you know what, there's some smart money buyers out here. They're buying bonds in anticipation of a pullback on the yields. And we did a trade earlier in the week where we did a bull spread. We got long of call option because on this day here, this is classic bottoming action. And I said, you know what? Let's get long here. Let's make a quick scalp. And we got out the very next day for profit. And plus you had RSI, which is pretty oversold. So we did well on that trade, but we're out. I'm not looking to get back in right here, right now. Until I see higher lows get put in, we're not at that point. Now, the daily chart today, we saw a down day, but all down days are not made equal. Sometimes they send you a signal. And what was the signal that was sent today? Well, despite the fact that the 10-year yield moved up to new weekly higher highs, the TLT did not put in new weekly lower lows and, in fact, rallied off the lows. You saw money flow into bonds late in the day. So that's a bullish sign from a growth perspective. So if you're looking to buy a growth stock, right, you don't want to see the 10-year yield moving any higher than where it is right now. You want to see the 10-year yield lower. So if the 10-year yield continues to move up higher, you want to avoid growth at all costs. You want to be in other sectors. Now, another signal that we may get a pullback on yields is that the tip market, which has been a basket case because yields have been moving up higher, the tip market, because remember the perception, what are tips? Treasury inflation protected securities. So what traders are doing when they're selling the tips lately, they're saying, wow, the Federal Reserve is really serious, despite the fact that their balance sheet continued to rip up higher until today, because they did 1/4 basis point rate hike. And just now, because they're jawboning more rate hikes more aggressively in the future, they took the tip market down because they believed the Federal Reserve was fighting inflation when they were not. So this week, you have the tip market calling BS on everyone and saying, no. We think that bond yields are going to come in, therefore increase inflation. You know what? We want to be buyers of the tips. So that's why you're seeing a bid in the tip market daily chart. And I know a lot of you out there saying, why is he talking about bonds? He's supposed to be talking about stocks. What I'm talking about right now is critical to your stock buying success. Moving on with the tips, we were oversold, to be fair, very, very oversold, and we were due for a short covering rally on the tips. So I want to put that out there as well, just in case you think about buying tips tomorrow morning. Watch the 10-year yield. 10-year yield moves up higher, tips are probably going to move lower. The dollar, very strong, but I'll tell you, I think we're peaking out here. You wouldn't know it by the performance of commodities today, but look at where we're at. We are at critical resistance on the US dollar. So what should that be good for? It should be good for commodities, but they've had a heck of a run. They're taking a break, and that's another reason why I think that we may be the only inconvenient fact out there to my thesis that we may be setting up for a rally in growth is the fact that the Tues just got hammered today. I mean, horribly hammered today. So that's that certainly puts a dark cloud over my thesis. But I'm a contrarian, and I believe that what we may be seeing today, or what we have seen today, was a bear raid, a bear trap. Traders looking to lure in shorts in anticipation of a continuation breakdown. Again, early stages of this thesis. I need more data. The coming days will provide that data, especially the closing price action weekly chart tomorrow on the week. Then on Saturday, I'll go over with members the week ahead commentary. Hey, listen, this is how we closed out the week. Here's our strategy for the new trading week. If you're not currently a member, 14-day free trial offer. Sign up. Contrarian Trader, link below. Why was there a reversal in energy stocks today? Great question, Trader Isaac. That goes to my argument. It goes to this. If I can find the chart, here we go. It goes to this. What we started out with. Where are we? Well, the market was in full recovery. What does well? Energy. However, when you start moving into a self-imposed bear market, not a self-imposed bear market, a self-imposed recession by the Federal Reserve, well then, if you're going to see a contraction in the economy because wages are too hot or the employment is too tight right now, which is why they want to slow down the economy. So in short, what they want is they don't want to pay people more, so they want to make more people unemployed. So if you're going to have less people driving around, less goods being produced, then why do you need so much energy? That's why. The VIX. What's the VIX telling us on a weekly time frame? If you can believe it, after today's price action, I just had to refresh this to make sure I wasn't wrong. We're down on the week on the VIX. We are not positive. Daily chart. Now, what we do have here, and again, I'm trying to validate my own thesis, right? That we may be seeing a bear trap. I'm so used to saying bull trap. So here's your line in the sand. And unfortunately, it's not looking good for stocks because what we're seeing here is a higher low on price. It's been validated by RSI with a higher low. And the other problem here is this, is that we broke out today on RSI. So we have an indicator leading potential price performance. Stokes are declining. The down below 50 rallies tend to fade. It didn't happen today. So we may be getting a higher low put in here on the VIX. Moving on, Dow Transports. We have a breakout week. The problem is that we have one trading day left to go. Do we hold this breakout here in green, or do we fade? Do we give it up? Is this a dead cat bounce on the transports, which were oversold a few weeks ago? Volume on the week is good. It's going to be above average. Daily chart. Obviously, a horrible day today, but I always like to say that the Dow Transports are your canary in the coal mine for equities. So if you have the Dow Transports that are behaving well, which on a daily time frame they didn't, but on a weekly time frame they had a good week so far. One trading day left to go. So we close out the day above the 50 and 200-day moving averages. That's pretty good. But it doesn't. If I had to bet a nickel, I'd bet a nickel against that we're going to hold them. Or we may pull back tomorrow, but I think we're going to put in new daily lower lows. The question is, do we bounce back? That's the big question. Big volume today. Stokes are rising. Skip the Dow Jones. S&P 500. Weekly chart was still up, but obviously a big fade here. So when do we begin to poop pickles in this market and look to short it? If we begin to break down to new weekly lower lows, I think we got to look at shorting the market. But when I look at the indicators, it looks as though on a weekly time frame, we're trying to put in a higher low on these indicators. And we are still up on the week, one trading day left to go. Let's check out a daily chart. So obviously today was just abysmal. Absolutely abysmal. Volume was low though. So, and this is what I was looking at earlier. Look at the down volume. It's very light. But the one thing that we I have to acknowledge is I'm trying to find a reason to be bullish. I really am. But at the same time, I want to be logical as well. That we have a lot of things going against us in this market: valuations, moronic government, ridiculous spending. We can't ignore this. This is a massive head and shoulders setup. And I'll use this as my 45-degree neckline here. I'll be looking to short this market if I am wrong on a breakdown below 435 on the S&P 500. I will be watching volume though. Volume will dictate how big I get to the short side. The trip Qs, they are down on the week, folks. One trading day left to go. We're down 3 consecutive weeks with volume potentially declining. Daily chart. I don't want to use that one. All right. So today's price action was just pure AIDS. It was just horrible, horrible, horrible price action. You can see we have the same inverted, not inverted. We have the same head and shoulders setup here on the cues, and we're right at that neckline. We're right at that neckline. Technically, we've already broken it. We just got a short covering rally that salvaged our butts out of the depths of heck. Family friendly show here, so I'm trying to be cool with my language. So I'm worried about a low rollover here down below 20, and if we get that, we're breaking down. We're going to take out the lows of March. But let's see whether or not this support level holds, or do we get a reason, any reason whatsoever, more Fed heads coming out, sensing the panic that's going to be in the market, trying to get ahead of it, and trying not to spook the market. I doubt it's going to happen, though. The banks. The banks are up on the week. I'm not going to spend too much time here. Very light volume. How much time do we have left? I want to go over those charts of Disney and Amazon. Technology holding support on the week. How did it do today? Bearish reversal bar, outside reversal bar, whatever you want to call it. But look at the volume here. This is what's getting me. It's like it's a buyer's strike. But here's your head and shoulders setup. Ominous. Semis up on the week, but still unable to close above support. One trading day left to go. Biotechs absolutely hammered this week. 52-week lows on massive volume. All right, so energy, this is a topic. So far on the week, we have a bearish key reversal bar. Very light down volume. MACD is losing momentum, a lot of it. Daily chart. So the other day on Market Wrap, I pointed out to members that we had broken down below this lower band of support and that we were on energy watch and that we may see a break. We got the break today. We were putting in lower highs on RSI. We never, ever got up to near that 70 mark, despite the fact that we were putting in 52-week highs on the XLE. So I think we are going lower here on energy. So the question then becomes, okay, where does money go? Does it go rotating into bonds, driving down yields, setting the stage for a rally in growth stocks? Maybe, but technically the growth stocks are looking horrible as well. If for some reason, maybe it's going to be the economic data coming out tomorrow. If it comes in weak, I know that sounds counterintuitive. The stock market right now needs horrible economic data, because the perception will be that the Federal Reserve will need to reverse course on their interest rate hikes. That will bring yields down. That may also bring on some deflation on durable goods, because if demand is not out there, then okay, then there's not that much pricing pressure on consumer goods. Consumer staples, different story. Food and energy, that's a different story. Those are going up higher. But you're going to probably see some deflation coming up in goods. And we've begun to already see that. And where it's reflected most is here. Again, I'm going to take you back really quick. Where do you want to be in this stage of this market cycle, right? We are here. Staples up here are working. They're working really, really well. You do not want to be in discretionary. Here are staples on the week. This is food, energy, anything that you need to get through your day, mandatory. You gotta haves. And we are up over 2% on the week. Sure, a little bit of a fade, a little bit extended. Yes, we'll probably get a correction in the next few days. But would you want to be an owner of this or this, where you have discretionaries, which are up on the week, but not looking healthy whatsoever. Gold. We broke out last week. This week, a bearish reversal bar. I do not want to see a close back down into this trading range tomorrow. That will raise all sorts of flares on my radar screen. So watch out for this. I'm worried about gold. I couldn't believe how weak the gold stocks were and the silver stocks. Cautionary warning out there. Volume is light on the week. Speaking of gold stocks, weekly chart. This is an outside reversal bar. This is horrible price action. We really need to see a rally back tomorrow, or if not, we need to hold $46 a share on the GDXJ, or you're going to see a lot of selling in these names. So we're going to have to lighten up and book some profits. All right. Oh, the one thing that is doing well this week for us, our little egg company. Everybody makes fun of me about my little egg company doing well on the week. We're up nearly 3.75%. We booked profits back here. We re-entered down here because we got overbought. We had a nice healthy pullback. We identified a support level. We got into that support level, around that support level, and now we're on the trade. I'm going to need to put a stop in here on Calmain. Let's talk about Netflix. Somebody mentioned this earlier. The N has been taken out, or the N has been taken out of FANG, and that's very true. So what we did is, and this is really not just a hit piece on Netflix. It's really a tell about the FANG names. I mean, Facebook is a dead company walking. Google, lots of government issues. Amazon, I don't agree with them. I think that Amazon is pretty much a monopoly. Netflix is obviously in a lot of trouble. And not all that I'm going to say about Netflix is negative. A lot of it's going to be positive. So let's take a look at what happened here with Netflix. We did an earnings trade on Netflix. And we did the same earnings trade back here. Now, the difference between this earnings trade and this one here is that the capital that we put up was significantly less than the capital we put up this time around. What we did is the same thing as last time. We sold Strangles. We were the market maker. And I always like to say that when you're a seller of options, which we generally are here at the Contrarian Trader, you are the casino and not the gambler. That doesn't mean that the casino doesn't get hit every once in a while. There's roughly 20% of the times where we're on the hook for a small loss or a big loss. And not that we've taken a loss yet. We haven't. We're managing the trade, just as we did back here, where at the depths of the trade, I thought I was going to take a big hit. But we managed to reduce the size of that loss dramatically because we bought call options when RSI was down literally at 11 on Netflix. So I bought a ton of call options. So, and technically, if I would have held on to the call options, I would have made a profit on that trade. Fast forward to this time around. This is a 4% event. 4% of the times you get a gap down like you did here. And I had very wide strikes. So this time around, I said, man, you're going out even further than you did the last time. I went 28% out of the money on the call side and on the put side. Okay. How did that work out? From the close on the eve of earnings, the shares are down 36.68%. Now, a couple of things I did right here. One, I reduced the size of our position, not the share count, same contract size as the last time, but the dollar amount invested was significantly lower on a portfolio, which was significantly higher. So it makes up much less of a percentage of our overall net liquidity than it did back here. So we're in a much better position to manage the trade. So what we're seeing at current on Netflix is I think we're setting up for a rally. The only problem is if this market melts down, well, Netflix is cheap historically right now. How do I know that? We closed out the day at 19.8 on a trailing PE. That, however, is that while its forward-looking PE is significantly less than it was this time last quarter, it can move lower. It can move lower if the overall market gives way. Now, I don't know if somebody was joking earlier that Josh Brown was talking about Netflix as a takeout candidate, but with this PE ratio, it's certainly possible. The problem is they have a ton of debt. So what do we need to see on Netflix for me to have a halfway decent weekend? Well, we're not going to make our money back by the end of business tomorrow. But what I'm looking for here is a rally back to close back above 231, last seen as support back here, December of 2018. If we get that, that would be a very, very good week for us because what we've done is we have booked profits on our call side strike. We resold those calls at a lower price. Those will expire worthless. We still have the put side strike, but we also bought call options on the position. So we've added to our long exposure of Netflix. So we've reduced our basis cost from around 250 to just below now 240. So we don't have that far away to go to get to break even and not perhaps even see a profit on the trade. For those people out there that get greedy when you're selling strangles, you want to print this chart up and really just watch it for future reference because it's not a place where you want to be. So I think that we are going to get a rally on Netflix. That rally is probably going to get faded. So I would get out on any significant rally. Now, as for Disney. All right. So, Donnie, I just saw you pop on. Donnie, did you make any changes to your trade, Donnie? Are you still long? Okay. So, Disney had a failed breakout here on the 20th. Continuation move lower on the day today. Unfortunately, we're going lower. You got out? Okay. 100% out? So where I think we're heading is okay. I understand that. I understand that. You did what you had to do. Talent. All I know is that Netflix earnings was told me a bad word on the report. Yeah, I didn't have kind words. So where do I think we're going on Disney? Disney, we're coming down here. 118, stop number one. Probably going to tap 117. If the market holds up, Disney may bounce off of 117. That's where I would look to be a buyer with a tight stop down below that mark. Donnie, I think you did the right thing, to be honest with you. If you want to get back in down here at these levels, fine, do so. Use a tight stop right below. Your risk reward, is minimal if you have to stop out right below 117. I greatly appreciate the care. Well, you're very welcome, my friend. You're very welcome. I think you made the right decision. Just understand, I can't give financial advice, so I can't direct you what to do. So I think you made the right decision. I provided options, but I think you made the right decision. And I don't think that was all that clear, but today certainly made it clear that we're coming down here. So Netflix, look for support. I think we're going to tap 117. Volume was heavy today. So with that, I have 9 minutes left to go. Bob, I'm thinking people were selling everything during the day because they were caught long and had to get liquid. Oh, because they chased the rally upward, maybe. So I'm thinking gold and silver will bounce, small bounce, end of the day. It could be a weekly retest of that breakout point from last week. So I'm not going to say you're wrong or right. I'm just going to say, okay, I just want to make sure we close above that weekly breakout point on gold. If we close back down into that prior trading range, I'm going to get all sorts of nervous about the gold stocks because something's up. Almost half the country dislikes them because they are woke. Yeah, it's amazing. And as a kid on Sunday nights, you used to have the Wide World of Disney show that used to come on, and you used to have Kurt Russell was the star back then for all the Disney movies and Witch Mountain. It's like, what the heck happened? Herbie the Love Bug? I mean, what the heck happened to this country, company? Yeah, Trader Isaac's right on. This has a split alliance that already at war. They will struggle when they win. Yeah, I mean, what they're going to have to go through down in Florida is abysmal. I mean, the autonomy that they've had and now lost is incredible. They're going to have to spend millions upon millions of dollars more for lobbyists down in Florida than they ever had to. There's going to be lobbyists in every town that they encounter. Every town government, every county government, they're going to have to cough up a lot of beans. Amazing. Complete incompetence. Okay. Okay. Let's do some short requests. I have to log off at 7 o'clock. I got to go to the members area first, see if anybody requested. Ticker cloud. Boom. Nobody. Wow. I'll take a couple of requests from the audience if you have any. If not, I will say, well, was Florida really smoked them? That they did. They messed around and they found out. That's simple as that. Stupid. All right, folks. If there are no requests, all right, Boyle and LABU, we'll leave it off with those. Boyle was very overbought. We expected it to come in. It did come in. Here's the monthly chart. It's still trending up higher. Keep in mind, the energy stocks pulled in. Weekly chart not looking good here. Bearish key reversal bar. Again, we're extended. We're probably going to retrace down to the 21 period moving average. Daily chart. Daily chart was a down day. The however is, if we break out, maybe they'll give it a short squeeze. Down volume, declining sequentially. I would wait for the breakout. I wouldn't hope for the breakout. I wouldn't even nibble here because I'm more concerned with the closing price action on a weekly chart. I think we're going to retrace back down to the 21 period exponential moving average. Hey, Jody. How dare you? So late to the show. How dare you? Hi to you. Welcome. You're always welcome. Whenever you arrive is okay with us. All right, LABU. Horrible day today. Horrible day. I think LABU is going to a 10 handle. I think we're going to potentially see single digits on LABU. It needs to gap up tomorrow. This is a bearish weekly chart. Bearish monthly chart. So you can see why this is the automated trend lines on TrendSpider. 35% discount code below for TrendSpider. Automated technical analysis. Click of a button. I love this. I get spoiled. Uh, we hit this resistance level. We were rejected. We can't buy unless we get a real serious pullback on LABU. I think the Stokes are very oversold, but that doesn't mean that we're not going to go lower. But if we break out above this upper band of resistance, we're going to be aggressive buyers of LABU. And speaking of the Stokes, let's bring them up. Let's take RSI off. I got so much stuff up here. See how oversold these Stokes are? You have a W formation forming. That doesn't mean that we can't pull down lower. The however is when you see a setup like this, get ready. Get ready for a reversal day. That doesn't mean that we're not going to see a 10 handle. It doesn't mean that we're not going to see single digits, but I think that we're going to get a vicious, vicious counter trend rally on LEBU. So I'm bullish on it, just not yet. You can do whatever you want, Jody. We value our female viewers here. There are so few. We have to treat you like treasures because if we don't, you're not going to stick around. So too much testosterone here. A little bit of estrogen keeps us humble. CYN. Massive short squeeze here. The setup was here. Here's your support levels. Bam. I guess it was news that came out. I'm not sure what. Does it have more room to run? That's your question. It's extended beyond its third standard deviation Bollinger Band. This is a very low cap stock. I don't know what the short interest is. I don't even know what the company does. So for all I know, it's going to $100 a share tomorrow. But omitting everything else and saying, okay, I'm looking at the technicals. What's the probability of what the stock is going to do? Let's go to the weekly chart. If it closes out the week above this resistance level here at 211 per share, what do we close? 211 per share. All right, so it's not much of a room here. We need to close flat to up tomorrow. If we do, and we get a retest next week of 188 per share, I would be a buyer at that level, tight stop right below. Actually, no, sorry. I need to amend myself. We need to close out the week above $1.88 per share, not 211. I looked at this number here. That's where we closed. If next week we retest 188 per share, which was resistance but should now act as support, I'd be a buyer there. If it fails to hold that, I'd stop out of the trade. But I would not buy the shares right here, right now. Why? It's because your daily 3D Bollinger Band has been pierced. So here's your support level down here. I'd sign up for TrendSpider, discount code below. Set your alert. And wait for your alert to get hit. Ideally next week, not this week. If it doesn't hold 188 this week, avoid. We have family-friendly show here. Okay, we'll leave it off Oracle. Avoid. Oracle broke down here on the 8th, rallied back in an effort to try to recapture support, rejected. If the market doesn't bounce back real quickly, Oracle's in trouble. Now, in looking at a weekly chart, in fact, I'm going to overlay on top of a daily chart because this is interesting. You don't see this often. So, daily chart, we'll look at where we closed today, right at weekly resistance or support. If we fail to hold this next week, Oracle's going a lot lower. If we hold it, there may be some hope for the shares. I would not buy them now, though. So wait and see how we close out the week. If we close down below 79.11, avoid. You're welcome, around. Sell in May and go away. That hasn't been the truth for the past decade, but this year I'm getting that feeling that you may be onto something, Larry. No, neither am I. And April is seasonally the strongest month of the year, and it's going to take a lot for this month to come back strong. So, um, buckle up. With that, folks, everybody have a great night. Thanks for joining in. Hit that subscribe button, like button, TrendSpider below, 7-day free trial offer, me, 14-day free trial offer. Get TrendSpider for free. Thank you for being here. I appreciate your time very, very much. I love the engagement. And everybody have a profitable trading day tomorrow. Talk to you on Sunday Night Futures Live again. Be